Okay. So, in today's rapidly changing business landscape, companies are increasingly looking to innovate and adapt to new market trends. One popular strategy for achieving this is diversification, which is expanding into new markets, products, or services that are unrelated to a company's core business. Think of it like a branching tree, or not putting all your eggs into one basket. While some firms have achieved remarkable success through diversification, others have seen their efforts falter or even fail spectacularly. So the question remains, can diversifying into unrelated industries really boost firm performance, or does it risk diluting its focus and expertise? Take, for example, the case of Google, which has successfully diversified into areas such as self-driving cars, smart home devices, and healthcare services. Meanwhile, other companies like IBM and Nokia have struggled to adapt to the shifting technological landscape and have seen their market share decline. The answer to this question has significant implications for businesses of all sizes and industries, from tech startups to multinational conglomerates. This paper aims to shed light on the effects of diversifying into unrelated industries on firm performance. Through an in-depth analysis of empirical research, we will explore the potential benefits and challenges of diversification, including the impact on financial performance. We hope to provide insights that will inform strategic decision-making for businesses seeking to stay ahead of the curve in a rapidly evolving market. Now, Roaa will give you a brief background on our literature.
Good afternoon. My name is Roaa Mohey. I will talk to you about our problem definition. Our research examined the impact of diversifying into unrelated industry on company performance. Prior studies yield conflicting results, from positive to negative. Positive impact, some studies found that diversification can lead to better performance by reducing risk and allowing companies to share resources across different businesses. And for the negative impact, other studies showed that diversification can have downsides, such as increased cost and lower profitability. The impact seems to depend on several factors, like the type of diversification strategy. Studies suggest that diversification strategy related versus unrelated can influence the outcome. The industry's development stage, studies found that diversification might have different effects depending on whether the industry is mature or emerging. For the unrelated diversification specifically, research by Rommel suggests unrelated diversification might lead to lower performance compared to other strategies, while Montgomery proposed an alternative review suggests the impact might be linked to the market structure of the industries entered through diversification. Now, Amany will dive into our research hypothesis.
Before we dive into the research hypothesis, I would like to discuss our problem definition. So the Egyptian corporate landscape has long been characterized by a dominant trend of unrelated diversification, where companies venture into unfamiliar industries in an attempt to mitigate risk and boost performance. However, the empirical evidence on the effectiveness of this strategy remains inconclusive and contentious. While some argue that diversification can lead to increased efficiency, improved competitiveness, and enhanced shareholder value, others claim that it can lead to costly distractions, reduced focus, and even declines in overall performance. The question remains, is it a viable strategy for firms seeking to navigate the complex and uncertain business environment, or is it a recipe for disaster? So, against the backdrop of conflicting findings in the literature, we formulate a bold hypothesis. Entering unrelated industries can be a game changer for Egyptian firms, leading to improved performance, but only if done strategically and sustainably. Our research addresses the question of how does diversification in unrelated industries affect financial performance in Egypt? By examining the factors that influence the outcome and providing insights for Egyptian firms looking to make informed decisions about their growth strategies. Now, my colleague will present you our objectives.
Okay, so today we embark on a journey through the intricate dynamics of diversification in unrelated industries and its profound impact on financial performance within Egyptian firms. Our study not only analyzes the direct relationship between diversification and financial outcomes, but also delves into the broader context by examining how variables like liquidity, debt ratio, and firm age shape these dynamics. And by unraveling the specific influences of diversification on return on assets and return on equity, we uncover strategic insights crucial for guiding decision makers and policy makers alike. Ultimately, our findings offer actionable pathways towards enhancing financial performance and fostering sustainable growth in Egyptian companies, underscoring the public role in strategic diversification. Now, Shahd will present to you our research methodology.
Good afternoon. I'm going to begin by discussing the research methodology we employed for this study. We aim to investigate the impact of unrelated diversification on corporate performance. We collected data from financial statements of companies listed on the Egyptian Stock Exchange, specifically EGX30. To be more specific, we ensured the data was clean and reliable, focusing on companies that had diversified into unrelated industries. We then standardized the data to make it suitable for regression analysis, and we collected we collected data from various Egyptian companies and utilized two key performance measures: return on assets and return on equity. Our independent variables included diversification, liquidity, debt ratio, profitability, and firm age. The more the variables we used, the more accurate our results are. We applied multiple regression analysis to understand how these variables influence the performance measures. In the ROA model, diversification has a positive coefficient of 0.070, which is statistically significant with a t-value of negative 3.220 and a p-value of 0.09, indicating that firms engaging in unrelated diversification tend to see a slight increase in ROA, suggesting diversification as a beneficial strategy for improving asset returns. Liquidity also shows a positive and significant impact on ROA with a coefficient of 0.050, indicating that higher liquidity levels contribute to better asset performance. However, the debt ratio has a significant negative coefficient of negative 0.440, meaning that higher debt levels are associated with lower ROA, highlighting the risk of excessive leverage. The model's R-squared value is 0.713, suggesting about 71.3% of the variability in ROA is explained by these factors, indicating a strong fit. Next, in the ROE model, the coefficient for diversification is even more pronounced at 0.405, with a t-value of 4.490 and a p-value of 0.046, signaling a strong positive relationship between diversification and equity returns. Liquidity also positively influences ROE with a coefficient of 0.103, indicating that firms with better liquidity tend to have higher equity returns. The debt ratio has a significant negative impact on ROE with a coefficient of negative 0.819, highlighting that higher debt can substantially lower returns on equity, likely due to the increased financial risk. This model's R-squared value is 0.690, meaning that about 69% of the variation in ROE is explained by our independent variables, which again suggests a good model fit. Next, with concluding our paper, Amany Abdelghany.
So again, in conclusion, our comprehensive analysis of Egyptian firms' diversification strategies has yielded a groundbreaking finding that venturing into unrelated industries can have a profoundly positive impact on firm performance. Our research reveals that Egyptian firms that diversify into unrelated industries are more likely to experience significant growth, increased profitability, and enhanced competitiveness. As Egyptian firms continue to navigate the challenges of globalization and economic uncertainty, our research provides a compelling argument for the benefits of exploring new and unconventional avenues for growth, which can unlock the secrets to long-term success and thrive in an ever-changing business landscape. Lastly but not least, my colleague will give you some recommendations.
Okay, we recommend Egyptian firms to use the following practical tips to improve their return on equity. Firstly, profit generation. To boost profit, consider expanding into new markets or offering new products. This opens up fresh revenue streams and spreads risk. Secondly, working capital management, which is improving liquidity by managing cash flow effectively. Thirdly, capital structure, which maintains a good balance between money borrowed and funds from shareholders. And this keeps your finances stable. Lastly, experience. And you can learn from both your successes and mistakes to make strategic and smarter business decisions. Finally, we would like to thank you for giving us your time and attention.